Good morning, everyone, and welcome to our webinar, Planning Ahead, Securing Financial Futures in California with Regional Marketing Director Derek Lape. This is Jordan, the Marketing Coordinator here at AIM. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box, and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, January 14th at 9 a.m. Pacific Time. Join Juan Garcia for Protecting Yourself from Life's Unexpected Events. And with that, I'll hand it over to Derek so that we can go ahead and get started. Take it away, Derek.
Thank you, Jordan, and welcome everybody. I'm going to apologize for my voice right off the bat. I have been under the weather since about Thursday, so it's my first day back, but we'll get through this with some great information. So we're going to be talking a little bit about basically some things that aren't as commonly thought of when it comes to certain policies in California, just because like we are here in Washington, California is very strict on what you're allowed to offer and what they have for options, as well as taking a kind of brief outlook on some things that have been discussed in the past regarding long-term care taxes and some different options coming up and what might happen with that. So start with some of the things that a lot of people don't really first have come to their mind, especially in California, is anything that has to do with hospital indemnity, critical care, the long-term care, hybrids, all that kind of stuff. Most of the agents in California are pretty familiar with that, but we'll get into that a tiny bit here towards the end. Versus those first two kind of boxes, something that really doesn't come up much just because there's not too many different options as far as carriers, products, things like that. So to start with, we're going to be looking at Manhattan's Life Affordable Choice. We're not going to go super in depth. We're just going to kind of skim some of these so you guys get an idea that there is actually some products that are available, right? So it's a nice little, basically just hospital indemnity plan. They have their different kind of groupings of what you want to choose. Obviously, they're going to have different premiums with things like Elite Plus versus Classic. One thing to note as we're going through a lot of these things that are kind of not as common, right, when it comes to having them available in California, there are going to be some differences per states. Certain things are allowed in some states that aren't on others. I tried to get the actual comparison guides from California itself, right? Doesn't mean it's always going to be 100% accurate. So it's something where if you do want to get more information on this, dig into it more, find out what you need to do, obviously give us a call here in the office. That's going to be the fastest and easiest way, right? But I mean, as far as the benefit goes, it's a pretty healthy one when it comes to hospital indemnity. There's a lot of different kind of payouts that could stack up on top of each other when you're going through it. Some other things that they put on there, which are kind of nice as well, is, Teladoc, the prescription EDO. So there's a lot of different kind of benefits that get rolled in there to help save a little bit of money. And then basically, one nice thing for this is, let's go forward. That little box on the left is kind of going to show you the lifetime maximum, as well as that upper box, right, calendar year limit. So, I mean, they could use this quite a bit, up to $1 million for the year, up to $5 million for lifetime max. So it's kind of a nice little option there that if there's something they're worried about or something that's going to be coming up, maybe they're in the hospital a lot, whatever the case, right? This is a good option, especially if it's one of those Med Advantage people that came in or, whoever really. But as you're probably familiar with, there's really not many options when it comes to hospital indemnity in California. So while this may not be the absolute, best plan you've ever seen, it does address kind of a shortfall of policy types in California, right? So if you have someone who's asking about hospital indemnity or, something in that nature, it's going to help be able to offer something at least. Now, as you can see on the right, the premiums are not the cheapest, especially if you've been selling Hospital Indemnity in other states. However, it definitely can help someone save some money because they are pretty generous payouts when it comes to the other stuff. Some of them, aren't going to be huge, right? So things like ground and air ambulance, it does have it in there. They do give you a limit of 2 daily benefits per calendar year, right? And it's only going to be $150 or $1,000, right? Depending on whether it's ground or air. Most of us know a ground ambulance by itself is going to be more than even that $1,000 limit, but it does kind of help stack on everything else, so they can get a pretty decent chunk of money to help cover costs. So yeah, the main reason for that was just to let you guys know there actually is hospital indemnity in California through Manhattan Life, which is kind of nice. So if you do have anybody who's reached out and asked you, if you've had it and the answer was no, or someone in the future asked you, there definitely is an option. Like I said, may not be the best, especially for other states, but in California, it's, kind of one of the only ones standing, right? Moving on from that, we're going to get into critical illness, right? Something else that doesn't get discussed a ton when it comes to California. Part of that is there's not too many options. So once again, as I noted earlier, whenever you're looking at different kind of plan features, layouts, benefits, whatever you want to call it, always check and see kind of the disclaimers, the things they're going to exclude. For instance, California, right? Down at the bottom, I threw that in there. It's going to tell you that there's certain things they're not going to cover, right? That they would in other states. I didn't get into the pricing for this one because there's quite a bit more options on what you can select and for how long, right? So it's going to be a pretty wide range based off of their age, what options they want for, lifetime coverage, term, what dollar amount they want for the actual coverage plan, right? But the nice thing about this one is, and the reason why it's up here is because there is pretty decent options through Mutual of Omaha, right, on this critical advantage portfolio when it comes to California. It's something that helps, protect people's assets, what's going on, and maybe they can't get, full on long-term care. Maybe they don't want it. Maybe they don't want complete life insurance. Maybe it's just too expensive for them, right? Maybe there's some kind of history of cancer or heart attack or stroke or whatever on, one of their parents' side that has them worried about it, right? They're still young and healthy. Basically, there's a lot that can go into this. It's a good way to pivot to something to sell it. As I mentioned, part of this that we're going through right now is just a general overview, right, of, well, there actually is some options, right? A lot of times when you talk to agents, they're not aware of either of these as far as being available in California. And so I just kind of wanted to get this out there to start the new year, so that way people realize, hey, there's some other things we can be pivoting to, especially for those agents who have mainly been focusing on, Med Sup, Med Advantage. They're looking for something else to kind of get back in touch with their book of business, right? Obviously, not all of this is going to fit. So, for instance, the highest we can issue here is 64, right? In California, if you got this client based off of Med Sups, they're probably older than 64, right? So not going to fit everybody, but there's some different options with some different things that just a lot of agents aren't aware of in California. A lot of you guys have seen this slide before. This is kind of where we're going to transition a little bit away from, hey, look, this actually is in California, to what might be. So as we all kind of know, California, like Washington, was talking about bringing in a long-term care tax, income tax, right? And it got put on hold for multiple reasons, one of which was the elections, which are going to be over pretty soon once everybody gets sworn in and all that nice stuff. So there's a good chance that that's going to be brought back up again at the very least, if not put into effect for the state. There are a large number of options for long-term care, right? Anywhere from just traditional standalone, whatever you want to call it, all the way down to life insurance with a long-term care rider. The reason why I say with a long-term care rider is if California is going to follow what we did here in Washington, as you kind of see down that bottom right, U.S. Code 7702B is going to be one of those things that they have to meet the requirement to opt out. Meaning it can't be critical cash, it can't be critical care, whatever it is. It has to be an actual long-term care rider or just traditional or hybrid, right? So that's going to be something that's really important when you have people coming to you. You're discussing different things about the possibility of the tax, especially as it starts to get picked up a bit more and back into kind of, the news coverage in different areas. That'll bring it to people's attention. Excuse me. So that's one thing to look for, right? And they may not care about the tax. You might be able to just go with life insurance, critical care. But it's something to keep in the back of your mind that it's going to want to meet, right, that requirement to qualify, if that's one of the reasons they're doing it. You're going to get quite a bit of uptick as far as people calling you, wondering what's going on, right, with, the decision that's going to be passed down. Obviously, they're not going to tell you right away. It's going to take some time, but it's one of those things where you can at least say, hey, we have an idea based off of what happened in Washington, what's being discussed here in California, of what might happen. And then you can kind of go from there, because you're probably going to start getting a lot of calls depending on how they actually initiate all this, like they did here in Washington. As far as side by side, right, these are two different couples. One went with the traditional standalone, one went with the hybrid. This would be one that actually does qualify. As you can see, the premium's a little bit higher on the hybrid side, which is a given. They're funding two different types of policies. One thing to point out, though, right, is the right side is going to be guaranteed premiums as long as they meet their payments on time, everything like that. They don't take out too much money, etc. Right? It's going to be locked in, just like most life policies. Both of these have 3% compounding interest. One nice thing that the hybrid side has is obviously second to die is going to get an initial death benefit. As you can see down at the bottom, there's still a guaranteed minimum death benefit if the plan exhausts the LTC benefit. So still going to be something coming out. There's definitely going to be a lot of different options there, right? Both of these, like I said, would qualify to be able to opt out, which is kind of nice. They're going to address some different areas for different people, right? So figuring out who wants what and for what reason. A lot of times if people are coming in, let's say for the long-term care tax, what happened here in Washington is it was a lot of people getting hybrids at the cheapest minimum dollar sign they could get it for. The reason for that is obviously they were just trying to get out of the tax, right? Plus side is it does help them a little bit, right? So you are still giving them life insurance with some long-term care in there. It does benefit them, but a lot of times that's their main drive. Usually you'll see that with people who are making over about 100K annually, because that's kind of the point where what you're paying into the state versus what you get back doesn't make much sense. That could be a little bit different with California. We'll have to wait and see till they give more information, but it's a good shot it's going to be somewhere around there. All right. As far as hybrids go, honestly, a couple of the most popular right now, especially for California, are both going to be through One America. It's going to be their asset care, and they're really great policies. Didn't put all the benefits down here, just kind of, the eligible impairments, the exclusions, the things that are going to keep people out. The reason for that is I just wanted to highlight for both this and the policy we're going to talk about next, the asset care. Both of these with the asset care here being pretty simple underwriting. I know it looks like a long list, but as you go through it, most of the things on there are going to be pretty heavily excluded from just about everything. They're going to be pretty extreme kind of cases of what's going on. As you go on to this page here, right, same stuff, pretty easy to get people through. Not going to be any real issues of what's going on. But one thing I do want to note here, right, is when you're looking at the different hybrids, figuring out what they really want to get from it and what's important is going to be a big thing to figure out from the beginning. If they're trying to get just out of the tax, that may or may not come. We'll have to wait and see. Probably not the route I would go. California is a little bit tougher because here in Washington, we were allowed to do IULs with long-term care riders. A lot of the carriers, with kind of the reading of the tea leaves or whatever you want to call it, of what's kind of looming down the road for California, they're not offering long-term care riders. So you can still get the critical cash stuff, critical care, whatever you want to call that, on their policies, but it's not going to qualify, right, for the opt-out, assuming that they're going to kind of mimic what we did here in Washington, which looks like that is the case. So there's not going to be as many options probably to get through. If they're trying to strictly just get out, right, I would look into a hybrid still, especially if they're younger, just because there's some good benefits that are going to come through. If they're closer towards retirement age and pretty healthy, maybe those standalones are going to be a better bet. But there's going to be some different cases there. One nice thing with the annuity care, which is similar to this, but it has even less, obviously, ineligible impairments, is that it usually about doubles, give or take, depending on what you're doing with inflation and different things like that, the benefit versus what you paid in, right? So you get about $2 back for everyone, which is kind of nice. And that's not going to be holding up 100% of the time, but it's just a general thumb, right, of it's going to be about double. When it comes to life insurance, still going to be a very, very healthy chunk of money, but it's also going to be funding the life insurance and the long-term care, right? So it's not going to be, if someone's in this to grow cash value, not going to want to go that way, right? As far as that life insurance, hybrid, long-term care. But basically, like I said, we were going to keep this short and sweet on everything. I don't want to go too into the weeds, right? There are some questions that have come through on some different areas that I will answer on some callbacks, just to be able to get a little bit more in depth on some of these. But the main point of this, right, this whole short little quick webinar to kick off the year, one, to get everybody used to watching webinars again, but two, to bring up a few different types of policies that are still needed in California, but a lot of agents don't know they even had an option for, right? Such as hospital indemnity, critical advantage policies, stuff like that, right? So two things that there is definitely a need for. You can see how much it's selling in other states, how easy it is to sell, but it's kind of lagging behind in California just because there's not many options. And a lot of agents didn't think there was any options after talking to many of you guys on the phone. So I just wanted to put that out there. And then if you have any questions on specifically those two things, go ahead and ask me when I or a team member reaches out for the follow-ups, or feel free to call in, right? That's what we're here for. And it's pretty simple to get you set up with them, to get going, and then get you some of the materials and everything like that. As far as what could possibly coming down the path, right, with long-term care in California, it's a little hard to say. I mean, it's one of those things that it looked like it was going to pass for sure. Then elections were coming up. It kind of got put on hold. So it wouldn't surprise me really if we never heard about it again, or if it gets put into play this year being 2025, right? So it could be something that gets pushed through very quickly now that they're not worried about having to kind of appease all their voters. But something that's worth keeping an eye on, especially as we get, 1-2 more months through this, once things start kind of clicking right down there with the government of everybody's in place now, what are we going to do? It could be something that's going to get pushed through pretty quick, maybe not, But you want to make sure if you are setting people up with this, that you actually are meeting that 7702B requirement, right? It is going to be huge. It's one of the things that everybody's going to make you have to be able to opt out. From there, obviously, you want to do what's best for your client. You guys all know that. That's why you're here. But you will see, especially if there's more pressure of this is coming, you're going to get a lot of people that simply just want to opt out of the tax. So that's going to have to be something that only you can really decide if that's the type of policy you want to take on or not. One nice thing with it is even though they're doing the minimum, right, just to get out of the tax, there's a very good persistency, right, or rate of keeping these people because they have to keep it per the state. So that's one nice thing to kind of consider there. But might want to make sure you have kind of all those things in line. But as I mentioned, today was going to be a little bit short and sweet compared to usually my over an hour webinars. Like I said, I wanted to get everybody back into the mood of webinars and just put out some information on some policies that a lot of agents didn't know was there. Without going too deep into any of them, because it is going to change quite a bit depending on who it's for, what they're looking for. So the easiest way is to just give us a call, shoot us an email, as you can see on the screen, and we'll get back to you and kind of help build that or get you appointed with them. But for today, I just want to say thank you to everybody. I hope you guys all had great holidays and look forward to talking to you soon. Thank you.